And welcome to our latest video report. I'm Dion Zukgroup, Branch Manager, Senior Wealth Advisor, and Portfolio Manager here again with you. And we have the festive season around the corner. We'll see if Santa brings investors some gifts this year as well. In this video, we're going to look at what happened in the US election. Does it even matter for portfolios? And also have a shift towards strategy. Also, we're getting closer to the final days of 2024, so we're going to bring in our associate Rachel, who's got some wonderful year-end planning tips for us as well. So we all know by now that Donald Trump will be the next American president. And this will only be the second time in history that a person has held this office in non-consecutive timeframes. In regard to policy direction, it's important to note that the Republicans also have a majority in the Senate and their House of Representatives, which may allow for future legislation to pass through more easily than before. So thinking out loud how this relates to the world's largest economy, a few things come to mind. One of Trump's priorities is to reduce corporate taxes. Now, this should definitely help companies improve their bottom lines, although, as we mentioned in the past, it will reduce the amount of government taxes coming in that help to service their debt. Trade tariffs, or import taxes, are a big topic right now, and is another focus for the Trump administration. They have a Made in the USA mandate, and placing tariffs on trading partners has obvious implications depending on which side of the border you're on. Keep in mind that using history as a guide, not all of these tariffs will actually happen. Sticking his chest out and speaking of tariffs is a favorite bargaining tool of the Trump administration. Lastly, the president-elect wants to reduce regulations, which should allow for better efficiency and ultimately more profits for most companies out there. So we have a pro-business backdrop, and we saw what's called a Trump bump in the US stock markets right after the election. Markets went straight up like a hockey stick, but since then have normalized a little bit. However, the US economic machine is still in growth mode. And this leads me to our next point. Does the politics of the United States really matter when it comes to long-term investing? Of course, we know governments can introduce policy that has economic effects, but in the big picture, profits matter a lot more than politics. And we'll show you a chart here. Since the late 1920s, US markets have returned an average of 8 to 9% per year. The percentage of years with positive returns is either 43% or 57%, depending on which party is in power, not telling us much. However, when we view earnings per share growth, whenever there are companies that have earnings going higher, this will also impact markets to move in that same direction. So currently, almost all of the largest publicly traded corporations have reported their latest earnings, and the American S&P 500 index is on track for a fifth consecutive quarter of earnings growth. In more good news, it's predicted that this will continue for the next round as well. All positive for market direction. All right, we have a positive backdrop. Which strategy should investors be looking at for the rest of this year and into 2025? Over the past few years, the global economy has been able to advance forward even with high inflation and rising interest rates. Today, inflation continues to moderate, interest rates are coming down, and other areas of the economy, such as wage growth and low unemployment, are looking good. So this means we expect 2025 to be another profitable year for investors. Will it be as strong as this year? Hard to say, and we'll have more crystal ball notes in our next video coming up in January. However, keep in mind, in the investment world, as we know, things don't always go up in straight lines. So we could have some short-term volatility that could return maybe from escalation of military conflicts or any wacko ideas coming out of the White House or Ottawa for that matter. As always, the best defense against this is to have money in different asset classes to reduce risk, something we always do in our models for you. If you have questions on your strategy in more detail, please contact our team. We'd be happy to talk to you about it. Finally, I wish you and yours a wonderful holiday season and a fantastic new year. Speaking of the new year, let's bring in Rachel, who's got some wonderful year-end planning tips for us, and we'll talk to her next.
Good afternoon. As we approach the end of 2024, I'd like to share some planning considerations. This could help optimize your financial strategy. This year brings some significant changes that may warrant consideration, particularly around capital gains taxation. So starting June 25th, 2024, the capital gains inclusion rate increased from 50% to 66.67%. This might sound technical, but it is easily explained. Here's what you need to know. For individuals, the first $250,000 in capital gains will still be taxed at the 50% inclusion rate, but gains beyond that threshold will be taxed at 66.67%. For businesses, the 66.67% inclusion rate will be on total gains. This creates a strategic opportunity before year end. So let me highlight 3 key areas to focus on. First, tax loss selling. If you've realized capital gains this year, consider selling investments with accrued losses. This can help offset your capital gains and potentially reduce your tax liability. If you have a non-registered account held with our team, we take care of this for you. So second is maximize tax advantage accounts. Your tax-free savings account contribution limit is $7,000 for 2024. It's likely going to remain for 2025. Your 2024 RSP contribution limit is 18% of your income, up to a total of $31,560. First home savings accounts for eligible Canadians is an annual contribution limit of $8,000 up to a maximum of $40,000. Each of these offers unique tax advantages worth exploring. Third, be mindful of alternative minimum tax, AMT. With changes implemented in 2024, high-income earners may be more susceptible to AMT. This includes scenarios like realizing capital gains, donating securities, or claiming certain tax deductions. And finally, a few recommendations. Consider timing your capital gains realization, pool charitable donations with your spouse for potential tax benefits, and review your investment-related expenses. You should also explore income splitting opportunities with your partner. Remember, the goal isn't just to minimize taxes, but to align your strategy with the broader financial objectives. Every individual situation is unique, which is why personalized advice is crucial. Contact us anytime with questions. And be sure to consult your tax professional for confirmation on advanced tax-related matters. Together, we can develop a tailored strategy that optimizes your financial position and sets you up for success in 2025. Thanks for listening. That's our report.